You guys hear us on Zoom? Yeah, Joe, you can hear me? Can you give me a thumbs up?
We can
I
hear you.
Hear you.
Cleared.
Perfect, thank you. All right, we'll go ahead and get started. So I have Ashley here with us to talk about a few different things as far as what I'm going to talk about on the lending is going to affect the closing process, and then we're going to talk about how we can help build some competitive offers in the climate of the market, because I'm sure you guys have seen going on right now. There's a lot of homes that are sitting for quite some time if they're not priced properly, but there are also homes that are flying off the market, and we're having to compete pretty heavily on these houses. And I had several people put in offers this weekend where they're waiving all contingencies except for due diligence, and we're getting things done inside due diligence. But a lot of the people that we're getting under contract right now are going through our fast track program, so they're getting fully underwritten before we even go under contract. We'll get into all that stuff later on in the class, but to kind of start, I wanted to share about our new down payment assistance program that we have that I think would be very advantageous for a lot of people who may want to start the home buying process, but may not have the funds to do so, or may not know where to get started. So I have a bunch of notes on our Dream Start program is what it's called. I took a training with our company last week to introduce this product. It came out on May 30th, so it is active now. We do have down payment assistance for both conventional and FHA loans. So one thing that I thought was pretty interesting about this program is for conventional loans. If you do go conventionally, some programs we have allow for as little as 3% down. So if you do put 3% down, the grant is actually for 5% of the down payment. So you can utilize 3% of the program towards the down payment and then 2% towards closing costs. So if you're able to negotiate any closing costs on behalf of the buyer, they could really be getting into the house with no money down at all. So just something to think about now. Actually, I know you've seen some down payment assistance closings. As far as the agent is concerned, coming from an attorney, what would you expect them to see if we do go through the down payment assistance process? Because it is a little bit different than just a regular standard loan process.
Yeah, so first thing is it's gonna be a longer close. So just because Shelter can get it done super fast, and does not necessarily mean that that is gonna be applicable when you have a down payment assistance program going on. Because that program is not exactly through Shelter. Okay, it's a separate underwriting situation. So Shelter could say, hey, we are 100% ready to go on like day 15. And then once they're ready to go, in the way a lot of them work, because they're not underwriting, some of them I think underwrite simultaneously, but a lot of them underwrite after the primary lender is done underwriting. So as soon as they're done on day 15, then they go through the underwriting with that down payment assistance program. So I would never do anything less than 30 days with the down payment assistance. I might even do 45 days with those programs, just because it takes longer. And keep in mind, the companies who are underwriting the down payment assistance, they're not quite as concerned typically with the customer service aspect of it. So they don't necessarily rely on the relationship to get the business. It's just the product. There's not a ton of lenders that offer this product. So they rest on the product alone. They don't have to necessarily try for the business. And so they're not going to be as accessible. You can't pick up the phone and talk to them like you can pick up the phone and talk to Hunter. So know that it's going to be a little bit of a headache to get to the closing table. And for a lot of people, it's worth it. You just want to prep your clients to say, hey, it's a separate process. You want to prep the other side, so there's no frustration when it doesn't close in 17 days like you want to close. So that's kind of the biggest thing.
Yep, absolutely. And again, with the longer closing timeframes, it is obviously going to be advantageous to maybe look at some of those houses we're talking about that have been on the market for a little while. They may give some seller concessions on top of that. Or I know, with this time of year, there's a lot of people that I have, plenty of 14-day closings where the client wants 35 days temporary occupancy afterwards, or they want 50 days temporary occupancy. So maybe you work something out with someone like that who wants the temporary occupancy till the end of the summer before they want to move. Then you get a little bit longer closing time frame. Maybe you shorten the contingency periods because we can get everything worked out. However, they do take a little bit more time to get the process done because again, people that need down payment assistance, there's only several places to go, so they're not very focused on speed, they're focused on just, providing the program and the grant for these people. So to get into what the program is and some of the requirements for it, these would be good bullet points for you guys to know if you're having an initial conversation with any of your potential clients or potential buyers. So this is a program that has no income limit. So people can be making however much money they want, and still qualify for the product. It is a second lien, so the reason why it has to be fully underwritten as well is because it's not necessarily a forgivable grant until a certain amount of time passes. So it being a second lien, it is in the second mortgage position. So with that being said, there are some underwriting requirements, and it must be originated with our FHA first lien product. So what that means is if we are going to utilize the down payment assistance program, we have a product when we go and lock the loan that shows that it must be originated with this product. Now, the only caveat I would say with this product is if the market rate is, let's just say 7% for ballpark numbers, then their first mortgage rate is going to be 0.5% higher than the market rate. So if they get 7%, then their rate is going to be 7.5%. And then the rate on the second lien, which is the down payment assistance and the grant, is going to be 2 percentage points higher than that. So if you're at 7.5, then your mortgage rate for your second lien, which is amortized over 10 years, which means that they have to pay the down payment assistance back over a 10-year period, and it's built into their monthly payment, is going to be at 9.5% if the market rate is 7. So rates, we are hoping that inflation data comes out tomorrow, shows some promising numbers, and that rates continue to slip down, because we are lowering closer to the mid-6s, but still I just locked a loan before I walk in here at 6.65. So better rates, not at 7, but still need some work to do to come down. So this product may be for someone who just got a raise at their job. So they just have gotten more income, they can afford the monthly payment, but maybe they haven't been able to save money because of whatever financial, situation they were in before. Maybe they ran into, a new job or whatever the case may be, but that would be someone that I would target for this product. And then potentially even someone who just graduated from college, who doesn't have, parents that are able to give them a gift or a down payment with the cost as well. So.
And I think one of the most important things on these products is telling your clients, I know Hunter mentioned that it's another lien, but they're getting a second mortgage. So like it is another security deed that is recorded right along or right immediately after that first mortgage security deed. And the reason I harp on this is I would say 90% of the closings I do where my seller had one of these programs, they have no idea that they had a second mortgage. So they think it was a gift. It's not a gift. Now, I don't know what the specific forgiveness terms are for your program, it's a 5-year set in here.
So it's fully amortized over 10 years, so they are paying it back over the full 10-year period. However, what I need to find out is more information on if the client sells the house after 3 years, what happens to that second lien? Because I think that it is forgiven at that point, but if they stay in the property and it's paid back over 10, let me clarify, because this product just rolled out. I wanted to announce it, let everybody know how the product works, but on the back end, I need to do a little bit more digging to see how the forgiveness works with the program.
Because that's interesting that you say it gets forgiven if you sell it, because that's the opposite of what a lot of the other programs are on the market, the way.
So let's park it there. I gotta figure out if that's the case.
Okay.
I think that may be how it works, but it is fully amortized over 10 years, meaning that it is not forgiven. So
Right.
if you sell it early, then that's where I need to look in to see if they have to pay back the company or what the case may be. But after the 10-year period, when it's paid off, they owe nothing towards the grant. I know that for sure.
Okay, the way I see most of them working, just in case y'all run into another one of these programs, is the most common one is 5 years, and after the 5th year, it gets forgiven if you've made your first mortgage payments on time for those 5 years. But some of them, if you sell in year 3, then you owe for those, like it forgives per year. So if you sell in year 3, you owe for years 4 and 5. Some of them, if you sell before you've lived there for 5 years, you have to pay the whole thing back. So I would say if you're using one of these programs, the other most important thing you can do is get with the lender, figure out what that forgiveness looks like, or more importantly, have your client get with the lender to figure out what the forgiveness looks like. to see if they really need to stay in the property for a certain amount of time to maximize, you know, the opportunity. that
So
presents.
with my notes, I think we have several different options. What I can
Okay.
do there, because I have reading here, I took notes on our repayable option. It's fully amortized over 10 years. I do believe there is a different option, so I need to do some digging on that. And I'll have an announcement on that team meeting tomorrow.
Okay.
We will reiterate this product. But some of the other requirements for the product is it has to be a 1 or 2 unit property, so it can be a owner occupied duplex. If you go FHA, which is, you know, pretty cool if they want to rent out the other side and start building, you know, some rental income history and, you know, figure out what to do after that, and then they can hold on to the property and move out and buy another one with some rental income. It can be used for condos as well, which is, I don't know if that's standard on all of them, but we can use it towards condos, which is, I thought was big.
Yeah.
If the condo is FHA eligible, obviously, if they're gonna go FHA, because we run into some obviously eligibility issues with condos if they do go FHA, and then modular homes are also actually applied here. So clients all over the spectrum can use this. The only properties that you can't use it on are 3 or 4 units. So if you're getting a triplex or multifamily, this does not apply. There is no POA option. So if this client is closing on this loan, they have to be at closing in person. So there's no option to get a POA, and there is no temporary buyout. So if the client locks in at par at 7.5, there is no buy down to get to 7.25 because they're getting a, you know, grant for down payment. So that usually means that they shouldn't have funds available to buy the rate down. So they're not allowing any temporary buy downs. As far as the credit is concerned, if their payment or if their credit score is less than 660, they can still qualify for the program, but their payment shock is not to exceed 150%. So what that means is if they're currently renting a property and their rent is $1,000 a month, then their monthly payment can be no higher than $1,500 a month. Does that make sense to everybody? And then if their credit is higher than 660, then their payment shock is not to exceed 175%. So with that being said, that means if their monthly payment was $1,000, then their payment on their mortgage cannot exceed $1,750 per month. And then the requirements for this, again, it's a second lien. It is 3.5 or 5% down or off the purchase price or appraised value. And then again, the repayable option is fully amortized over a 10-year term, and an interest rate that's 2% higher than whatever their first lien is. And then again, as I mentioned, if they do go conventionally and they get the full 5% of the, you know, down payment assistance, they can allocate 3% to the down payment and 2% to cover closing costs, which I thought was really big. Because a lot of people that are looking for down payment assistance, they might not have too much money saved up at all. So if you buy a $300,000 house, what we usually tell people to be expecting of is about 6 to 6.5% of the purchase price all in with a 3% down payment, and then 3 to 3.5% closing costs depending on taxes and insurance. So that would be right around $18,000 to $20,000, and they would get at least 5% of that in the grant. So they will come to $3,000 to $5,000. So definitely a good option. Sure. So that's all the info that I have on our down payment assistance program for right now. Before we move into some of the new products that we have, does anybody have any questions, or after you have anything you want to add on down payment assistance?
No, I think we covered at least what I see from my side.
Yeah. Anybody on Zoom have any questions on that?
Looks good from here.
Perfect. So the next thing that I wanted to talk about was another new product that we have announced at team meeting. It is that Borrow Smart Access program. This is very, very creative program. It helps lower the interest rate as well as the clients get a $3,000 credit back at closing. So if you have clients that are making less than $134,000 a year, this could be one borrower or it could be 2 borrowers combined. So if they're both making $65,000 a year, that's $130,000. If the property is in an eligible area, so you guys can send me the property address, I can run it and let you know if the property applies to this program. It is in Atlanta and the surrounding areas. So I had a closing on Thursday that was in Smyrna that used this product. I had one a week ago on the 31st that uses product in Morningside, Virginia Highlands area. And then we have a few other people looking around in Alpharetta, Peachtree Corners that are gonna use the product as well. So it is several areas around Georgia, except for the area median income is what we're using. So in these areas like Fulton County, in Peachtree Corners, in Smyrna, the area median income is $96,500. And we are able to gross that up to 140% of the area median income. So that means we could use 134 or below, because that is 140% of that $96,500 figure. Now, what the product is it is a conventional loan. The grant is a grant, so it does not have to be paid back. This is Freddie Mac trying to help people lower their cash to close and give some initiatives to first-time home buyers. So this product is only for first-time home buyers as well, at least the grant is. Now, the interest rates that are the premium rates, we can get those for people that are repeat home buyers, but their parameters of their loan do change. Have to go 5% down. We can use the area median income to get lower interest rates in different areas. So that's something that we're looking at. Like I did an 80% AMI on an Alabama loan that I have right now because it's within the income threshold. So no matter what the property is, once we input that property address into our system, when I price out the loan and I see the products available, it will show me if this property qualifies for that product. So this is not just for Georgia, it's not just for Fulton County. This could be a potential for us to look at on several different loans. So that's why I think it's really important that hopefully we'll get the chance to talk to your client, because if we're competing with another lender on rates, we're gonna be well below where they are with these products. For the product to, be originated and go through, the client does have to take a counseling call. So what that is I will set up a counseling call for them online with the Borrow Smart Access program through Freddie Mac. It is a 30 to 45-minute phone call and ask them what their income is, where the money for closing is coming from, what their budget is. So they'll go through a whole home buying, counseling workshop almost for 30 or 45 minutes. Once that is taken, the counselor gives approval for the product. They have to send us a certificate that says that the client does qualify. So there are some, things that the client has to go through, but how I framed it to the client is if you talk on the phone for 30 minutes, you are making $100 a minute. So if you can just, take your 30 minutes and you make $3,000 off your cash to close, I think that's worth it for both me and you, because I'm going to be able to compete or beat any other lender that you talk to, and you're going to save $3,000 and it takes you 30 minutes. So if they have a problem with the phone call, that's how I frame it. It is an awesome product because there's no loan level pricing adjustments. So as you guys have heard in the news, we've talked about it, how there are loan level pricing adjustments for different credit scores at different down payments. So what that means is with this product, if you have a client that has a 660 credit score, they're going to get the exact same interest rate as someone with an 800 credit score. There's no difference because there are no loan level pricing adjustments, which means that the rate is going to be the lowest rate that they can qualify for without buying down the rate, and they can still buy down the rate on top of that if they would like to do so. Now, the grant is a forgivable grant. It is just to establish homeownership. So there's no caveat as far as they have to hold the property for this long, they have to pay this back. This is just a $3,000 grant that is coming from Shelter and Freddie Mac to establish the homeownership. And again, these rates are about half of a point below the market rate. So I don't want to give any examples because the market's moving so much, but I logged into somebody, the rates were at about 6.5, 6.165. They got a 5.99 rate and they closed May 31st. So it shows you how much more competitive these rates are. They get $3,000 off their cash to close. So you can obviously, let them know that that's going to take care of a good bit of their closing costs and it can be allocated that way. So we had a client get $15,000 in silver concessions. They used a $3,000 grant. They paid their earnest money and then less, whatever the amount their down payment was. They brought nothing else other than their down payments at closing by using the product. They got a 5.99 interest rate. So
I think that's also, we don't see a whole lot of lenders having this kind of grant. The down payment assistance is different because it can be forgiven, right? But it's not necessarily forgiven. A grant is essentially a gift. Like there is no, like Hunter was saying, caveat to maybe have to pay it back. So it's like free money. That's huge.
Yeah,
And
and
very
then
unique deal.
what I would say about this product for you guys, if you guys are gonna send us a client who wants to qualify for this product, it's a great way to get them to have a conversation with us if they're talking to another lender. I've had several agents that I reach out to that post their buyer needs online. They put, in a price point in an area where I knew this product would qualify. I called them, said, hey, it might be of interest to your client to have a conversation with me. They're like, oh, well, they got pre-approved by a bank and they just said that they're gonna work with the bank, but since I told them about this product, they're interested in having a conversation with a local lender. So it's another way for you guys to talk to us, not have them shopping with, the Rocket Mortgages of the world. Obviously, that's who does the loan, that is what it is, but, we can definitely streamline the process and we can close this in 14 days. So it's still not a longer closing time frame. It's quick. But if we do close in 14 days, once we're under contract, they gotta have that phone call pretty immediately, because we can't send out the closing disclosure until that call is completed. So, just one kind of hiccup that could happen if it's a quick closing time frame, but they can usually schedule the call within 3 to 5 days. So the client's not, on vacation or something, it shouldn't be a big deal. But again, super advantageous product. And then, if you do have a client that you are sending our way to talk about this product, make sure that you make it known that it is in certain areas. Because if they go and they look in Douglasville, this is not gonna apply because it's the area median income is below what it is in Polk County. So if you guys have people that are looking all over the map, let us know what properties they want us to run numbers on, because my interest rate is gonna be half a point different on one property than it is the other. So if I send somebody a monthly payment using the product, but your property doesn't qualify, their monthly payment's gonna be $100 higher, and that's a problem for both of us. So I always make it known, hey, if we are gonna go with this product, you need to let me know what the property is you're looking at, so I can tell you if it's eligible or not. And this again can be refinanced like a conventional loan. We'll refinance out of it into a lower rate when the rates drop. And we still are honoring to waive the lender fees on a refinance. So when you tell the client all these things, I'm basically giving them $5,000 in seller concessions. Not technically, not actually, but I'm giving them $3,000 grant, and then we're waiving the lender fees on a refinance, which is $2,000. So we can basically tell your client, working with me is going to save you $5,000 over the course of the next 24 months. Plus whatever the change in the interest rate is going to save you on your monthly payment. And it's a great talking point to get people to, at least have a conversation with us. So.
Question. Things are going by a little fast. I'm trying to take notes and without a bullet point slide. So in the first program, you get down payment assistance, but it takes 30 days. Second program, you don't get down payment assistance, but you get closing costs. Isn't the down payment assistance program giving you more money ultimately than just $3,000 in closing costs? What's the buyout there?
Yeah, so the down payment assistance can give you, if you're going FHA, it can give you the full 3.5% down payment. If you're going conventional, it can give you up to 5%. So again, if you go conventional and you're a first time home buyer and you get the 5% grant, that's going to cover your whole 3% down payment, along with 2% of your closing costs. But with this product, we are not able to we're not able to prepare a super competitive offer. So if you have if there's multiple offers, if you have to go with down payment assistance, I would say that unless for whatever reason your offer is well above the other ones, or the client has, some sort of reason to stay in the property for longer than a quick close, you're not going to win on that property. So this is going to be for people who ran into a salary increase, but they don't have any savings that want to buy a home that can qualify for the loan. But this is going to be a product where you may need to look at houses that are going to be on the market for a little while, or have some sort of reason for a longer closing time frame, because it does have to be a 30 to 45 day close. And I have not done one of these yet. The product just came out. So I'll keep you guys updated when I do one on what the process is like. But I have done down payment assistance at my previous company, but it was a different program. I did the Georgia Dream, which is pretty standard down payment assistance program. And that my company was cleared to close in 18 days, and we didn't close until 35 days. So it took 17 additional days for Georgia Dream to do their underwriting process. So that's why I say you just need to beware, because if we do a 21-day close, we can't close for 40 days, then you're outside of your 8-day unilateral. You're leaving the client's earnest money exposed, and I'm sure we could talk about a step for the down payment assistance being approved, but I've not seen or heard of that.
Yeah, I mean, you could certainly craft a SIP for that, but essentially you're creating a secondary loan contingency. So it's probably easier to just use the either FHA or conventional form and then use the first mortgage and the second mortgage box. Because those contingency forms are set up to have two mortgages. So Joe, kind of comparing the two, the reason that this other program, the not down payment assistance,
It's called Borrow Smart. Access.
Borrow Smart Access, why that one would be advantageous, even though it's less money, is first off, you don't have to pay it back. It's a full-on grant, and I don't want to use the word gift, but it's essentially a gift, like, you're not gonna have to pay that back ever. Whereas down payment assistance, you might have to pay some or all of that back, depending on the circumstances. Second, with, and I've already forgotten it, Borrower Smart.
Borrow Smart.
Borrow Smart. Okay. Borrow Smart, your rate is gonna be lower, whereas down payment assistance is gonna be higher than market average. And then third is the closing time frame. So it's not that it's the same sort of program and one is just more money. They're totally different programs for totally different borrowers with different, advantages and disadvantages.
Right, so on the smart access, you have to have the down payment. They're just giving you closing costs, right?
Correct.
All right, what about a program like CHOA? Is that still in effect? Is that better than the other one that takes so long to close?
Genoa, it's the exact same thing, basically, as this Dream Start program, but for Genoa, I think it's only FHA, where this one allows you to do conventional and FHA, and it's still a longer closing time frame. Still the same parameters, they're giving the down payment assistance at the second lien, it's got to be paid back, and it's gonna take longer to close, because they're gonna have their own underwriting guidelines as well.
Pretty much all of these down payment assistance programs are gonna be the same thing. They're gonna end up being more expensive. They're gonna be maybe forgivable, and they're gonna be a much longer close for all of them.
And so I would say the difference, if you want to put it in terms of comparing these two products, Borrow Smart, if the interest rates are 7%, and that's the par rate, the market rate, for Borrow Smart, your client's gonna have a 6.5% interest rate, you get $3,000 back. If you're at 7% as the market rate, you're doing down payment assistance, your client's gonna have a 7.5% interest on their first lien, 9.5% on the down payment assistance, and they're not gonna have to bring as much money to the closing table. So these are gonna be for people who literally just started thinking about buying a house, but they're like, hey, I just got a promotion at work, I can afford a little bit higher monthly payment and refinance it to something lower later on. But for the Borrow Smart Access, these are people that are probably been preparing to buy a home for the last 6, 12, 24 months. They're ready to go, but they're just able to qualify for this $3,000 credit, which allows them to lower their cash to close. This is not gonna be a product that you're gonna share with someone who has no money to close, because it's not gonna do enough of a difference, but it's gonna save them a ton of money on their monthly payment if they do qualify and they're prepared to buy the home. So this is gonna be for your first time home buyers that are prepared and ready to go, but would just like a lower interest rate of $3,000 off their cash to close, which I would say is every single first time home buyer. If they're ready to go, so, and I will say, the only down payment assistance that's better than what we're talking about would be a gift from your family members or relative for the down payment. And if you got a gift, we could still use Borrow Smart, so they can technically get, I'll call it down payment assistance from your parents. It's not a product that has to be underwritten. All we need to do is do a gift letter, and they send the money straight to the attorney, and it's very simple. And then they can get $3,000 off closing as well. So that's, if you're talking down payment assistance, if you want to go Borrow Smart and get assistance, I would get assistance from your parents, because you're not getting a second lien that has to be, paid back.
Okay, so with Borrow Smart, said that was conventional.
Yeah.
Pretty much. So does that mean that you can't qualify for FHA, it has to be conventional?
So it has to be conventional to go that program. Now, obviously, if you can qualify conventionally, we could qualify FHA. So if they wanted to do down payment assistance, we also have down payment assistance for conventional. But if it is an FHA borrower, that product does not apply, because it is a Freddie Mac loan product advisor product. So it has to go conventionally to get that grant.
And the credit score.
640 or above. But the thing is if you can get to 640, your credits or your interest rate is the exact same as someone with 800. So we can do credit enhancement, which great question, because this brings me into my next topic for today is our credit enhancement. So going into that.
I have a quick question. Sorry. Before we leave. So for the Borrow Smart program, when you say first-time home buyer, is that a true first-time home buyer? Or is it someone that hasn't purchased in the last 3 years?
Great question. So it is someone who has not purchased in the last 3 years. So if they do not have a mortgage on their credit report for the last 3 years, they can also qualify for this program. So it's not a true first-time home buyer, but if you had someone that bought a home and sold it in, 2018, 2019, or 2020, potentially depending on the date they sold it, and it's not on their credit report for the past 36 months, then they can qualify for this program as well. I actually have a client doing that as we speak. So great question.
Okay, thank you.
Yep, and then, so as far as the credit enhancement goes, parents, it asked me a great question to kind of transition into that. So Matt had a client that did CE, and then I had one as well. We're gonna talk about this at team meeting again tomorrow. But he had a client do CE to then qualify for Borrow Smart. With the interest rate they were at, the product, program, they're gonna have to go FHA. The interest rate is gonna be a little bit higher than the credit score. They did CE, got the credit score to 641, so just over that 640 to get them to qualify. Drop the interest rate significantly. It's over 0.5% at that point because there's no loan level pricing adjustments, and going from FHA to conventional is gonna change the parameters of the loan pretty significantly. There's none of that upfront mortgage insurance premiums that they have to pay that's rolled into the loan amount, which makes their monthly a little bit higher as well. So not only lowered that, but it lowered the MI factor, so the mortgage insurance factor is lower as well. So they went from like 620 to 641, and it's gonna change their monthly payment a couple $100 and let them actually qualify for the home they wanted to purchase, instead of being really nowhere near qualifying for the other product. So another thing to think about, if you guys have people that are on the fence that can maybe, are close to qualifying, maybe this product is something they want to look into to help them with the rate, help them with the product, and get them another grant at closing. And then I had a client that's under contract closing next week, and they are going FHA, so 3.5% down. Had some delinquencies on the credit report from a while ago that they've been cleaning up, which they're very well qualified, other than the credit score, it's like their one hindrance. And the credit score was at 594 when I locked the loan. They were paying 3.3 percentage points to get to their par rate because of the credit score. And the loan amount's like $455, so they were paying almost $15,000 for the buy down, and that was obviously a problem, and they did not like to see that, which I was like, hey, bear with me, trust me that we're gonna take care of you. I'd already priced the loan out for what they said the credit enhancement was gonna do to the credit score. So I can manually input a credit score to tell you exactly how that's gonna change the parameters of the loan. So they bared with us. We extended financing contingency 2 days to make sure that the credit enhancement could be done inside of that period. Because if, for worst case, the credit enhancement is done and the credit score goes down, they have a chance to be below 580 to where you would qualify for an FHA loan. So we made sure to extend that. I talked to the agent, I said, hey, here's what we're doing. Everything else looks very solid. We've already been through underwriting. We just want to make sure this lines up, and it takes a couple business days to do. We got it done last Wednesday. We had financing sent until tomorrow. So we've already taken care of everything we needed to take care of. But the credit score went from 594 to 610, and they went from paying $15,000 to $4,000 on the buy down. And we also got them $2,000 in seller concessions after the inspection. So their cash to close went down $12,000 in 2 days from credit enhancement and just getting an inspection done and having an agent work on their behalf. So again, I never want to send out disclosures that scare people, but I also sent it out saying, this is the worst case scenario. You need to be comfortable if we stick here. This is what we have to do to qualify for the loan, because there's no par rate. And then once we do credit enhancement, if it does, take effect, then this is what your new payment will be. And they're like, okay, that's perfect. Got it done. Cash to close went down, like I said, $12,000 from the original disclosure. We sent out a new disclosure. Now everybody's happy. We're still inside of our financing contingency right now. So even if, anything were to happen, we're still protected. The clients had several days to make sure everything is comfortable, and they're good with it. And so that is going to save them a ton of money at the closing table. So
Yeah, and I think it's really important with credit enhancement that y'all direct your clients to Hunter to take care of that. Don't say, oh, well, let's pay off these credit cards, or let's guess. Because what I find is that most people don't actually have a good grasp of what really is going to help their credit score. So why spend a bunch of money, on something that may help, may even hurt it? Because like if you have a credit card that's been standing for a long time, you're like, I'm going to pay it off and close it out. That might hurt you because it's, a long time period. So just don't make guesses. And if your client's like, oh, I'm really working on my credit score before I apply for the loan, I would try to get them to kind of change the order of things in their mind and call them and let them tell them what the actual best thing to do for their credit score is.
Yeah, so my biggest like real world example from that is it happened to me actually last week. So my parents had put me as an authorized user on a gas card for QT when I was in high school. And, you know, just allowed me to use the gas card for gas. And I've been an authorized user for 6 or 7 years now. I was in high school when they did that. And my mom was, I guess the credit card was about to expire, so they were talking to the company, they're like, hey, we need to, you know, renew the card or whatever, get a new card so it doesn't expire, and I was still on the profile, and obviously my parents don't give me a gas card anymore, and so they're like, if he can be taken off as an authorized user, and that was my longest history of credit, so I checked my credit score on Thursday or Friday, because I got an alert that it had dropped for whatever reason, and I make all my payments on time, so it's very strange. My credit score dropped 35 points. It went from 790 to 755 because I was taken off as an authorized user on a card. So that can just show you how crazy, if you just make one decision that you're like, I don't know what this is gonna impact. My mom was just like, he doesn't use the card, he doesn't need to be on it, so let's just take him off. And if you're going through the process of buying a home or getting a car or whatever the case may be, that could change your monthly payment hundreds of dollars if people do that. So I called her and hey, put me back on the card, please, because I'm not gonna use it, but I need to be put back on, because it just, you know, dropped my credit score 35 points in all 3 bureaus. It wasn't like it was just one, it was all 3 of them. And so it's a pretty dramatic impact, but if your credit score is at, you know, 600 or 620, you've got 40 points, but if you do something like that, you may not qualify for a loan. So just another thing to think about, if you guys have kids that aren't authorized users, or if you guys have kids that are at the age where they can build credit, make them an authorized user and just don't give them a credit card. Just let them build credit in their name. You know, if you don't trust them to use the credit card, just put them on as an authorized user and just pay off the card as if it's them using it, but it'll help them establish and build some good credit as well. So.
It's like a credit card with a really low limit for them to buy gas and then.
Exactly.
Or, yeah.
Yeah, something like that.
What is the, you talk about credit score, what is the minimum credit score to be able to get any of those programs?
580 is gonna be the minimum for an FHA loan, and so the down payment assistance program, it's gonna be dependent on if they can qualify for the loan, so you can go below 660, but it's gonna, the payment shock I was talking about, so if they're
Okay.
renting currently and their payment's $1,000, their monthly payment cannot be above 1,500, because payment
Okay.
shock is their payment increasing once they buy a home, so they don't want them to get down payment assistance, double their monthly payment, and then they foreclose for whatever reason, so it's just their parameters to make sure that we are giving this out to people who are gonna be able to pay this off and pay for it, not put them in a hole. Because, you know, a lot of people that call and they've got, you know, $100 in their checking account and they wanna buy a home, may not be the best time to buy a house for that person, but this, if they just got an increase in their salary, like I said, perfect for them, because now they have more money to save, more money to use to pay off the home, and they can get the grant for the down payment. So it's probably someone in that ballpark.
Thank you.
Yep. And then I got 2 more topics that I wanted to talk about. So Ashley, this is perfect too. I know you had a class on this. We're talking about just a competitive offer in this market. So as far as with the loans you're closing in your office, or homes, I guess you're closing in your office, what are kind of the parameters of all these offers that you're seeing as far as being accepted and closing? I feel like they're all pretty quick timeframes unless the house is sitting on the market. So I just wanted to explain again what we're doing as far as our offers and how we're trying to win out on a lot of these houses.
Yeah, so we are seeing offers kind of tighten up or become cleaner, if you will, meaning shorter or less contingencies. So I think one really great tool, first of all, the very first tool you should use if you don't have a cash buyer is utilize Hunter. First call you should make is to your lender when you're filling out a contract. Because what you want to know is how many days do you need for financing and how many days do you need for appraisal. So if you're able to have those contingencies, you want to make them as short as you can, but what you don't want to do is make them so short that the lender can't meet them. Because they're not really in control of when the appraisal goes up or when the appraiser goes out there, right? So the other thing to keep in mind is neither one of those contingencies are set up to say, if something's not done, my buyer can terminate. That's not what either one of those contingencies are for. The loan contingency is if I get a denial letter, then I can terminate. And no legitimate lender is going to issue you a denial letter just because they're not done with the process. The appraisal contingency for conventional is set up to say if the appraisal comes in low, then the buyer can request that there's an amendment to the sales price and the seller reduces it, they still have to buy it. Which means if they don't have the appraisal back, they don't have a chance to turn in that amendment. They don't give the seller the chance to accept it. You can't just terminate because your appraisal didn't come back. So getting a very clear time frame for both of those is gonna be important. And what you can do that I think is gonna be pretty attractive, I think, for sellers is, let's say you get, for loan contingency, what is like the quickest y'all can do?
So we always do, like, I had 3 people that were under contract yesterday, they're all waiving financing and appraisal, we're doing 5-day due diligence, we'll have the appraisal back on Thursday.
Yeah,
Because
so,
they've already been fully underwritten. I will never waive the contingency, I won't even tell you all the inside of due diligence if we're not through underwriting or if it's not super clean and we've already gotten a chance to look at it. But we are fast tracking all these people, which means they're fully through underwriting. Once they're fully through underwriting, we get a list of conditions that are gonna be coming up again when they're re-underwritten, when they're under contract. So for those of you guys that know about the fast track program, once we're under contract, it has to be fully underwritten again with the property address, with the appraisal, or with the appraisal waiver, if we get one. But all the conditions will stay the same if your employment, your income, your assets have not changed too significantly. So it's a very quick process once we're through. So if there's any minimal conditions, we'll go ahead and fulfill them before we get the contract. And then once we're under contract and it gets out of underwriting again, we have two conditions that are cleared to close. So it's a very, very quick process at that point, and we can close, pretty quickly. So 13 to 14 days. And I got a contract this morning, it's closed 2 weeks from today. We waive appraisal, we waive financing, because it's already through through fast track. And then they're putting down a significant amount of money from the sale of their last home, so we got an appraisal waiver, so I don't even have to get an appraisal. So I'm like, hey, give me 5 days due diligence to get the appraisal in, well, we got a waiver, I don't even have to work it now. So now I know we're good, as long as the inspection goes well, then we're gonna be good to go. And we'll get it re-looked at by the underwriter before Friday, so the, due diligence doesn't expire without anybody looking at it. But these things have already been taken care of, and they should be, good to go as long as nothing changes.
yeah, and that's what I was gonna say is a great idea, is if you have that time frame and it's not super long, so like 5 days is definitely not long, just put that in due diligence. Because I think what a lot of people don't realize is they hear me say you can terminate for any reason in due diligence, but I think, oh, I waived my loan contingency, I waived appraisal. No, you can still terminate for those reasons in your due diligence time period. You can terminate because it was raining outside. You don't even have to give a reason why you're terminating, just under the right to terminate under due diligence. Boom, done. So if you're trying to make it more attractive, rather than having multiple contingencies, stuffing it all in one box, under the due diligence box, I think it's gonna be really attractive for a lot of sellers.
Yeah, like I had a 10-day due diligence and a 5-day financing, and I was like, you can just waive financing at that point, it's where it looks stronger. Because if we have 10 days due diligence, I get financing done inside the due diligence, so it doesn't matter if there's a contingency or not, because you don't have to give a reason. Therefore, we don't have to deny the loan,
Right.
we can just say, hey, not gonna work. We'll regroup and figure it out, not that that's gonna happen, because we've already fast tracked it, so it doesn't matter. But, again, that can just be something that if you can get a 10-day due diligence period, you can waive everything else. We can absolutely get everything done inside 10 days. And then another thing that I've had some people do that I think is very advantageous, it's kind of tricky and it's very good for you guys to know, but they put the due diligence period in the, loan exhibit, and then at the bottom, they put a stipulation that these
Is it
days.
the loan contingency?
Or they-
The loan extension, or
no,
still just the
yes.
purchase sale?
Yes, purchase and sale, excuse
Okay.
me, and then they put a stip and it's only business days. So therefore, whenever it's just business days, that gives us a little bit more time, because we're not underwriting a loan on the weekend. So they use it as they say, these, contingency periods only fall on business days. So therefore, if we have 7 days due diligence and you go binding on Sunday, that gives us until the following Tuesday instead of the following Sunday. Because I just think that's been very helpful for me. Because if you see 7 days due diligence, that's pretty quick, maybe 5 days, it's pretty quick, but if you go binding on Tuesday night and I have 5 days due diligence, well, that expired Sunday, so I have Wednesday, Thursday, Friday, which is not necessarily enough time to order an appraisal, pay for the appraisal, schedule the appraisal, get the appraisal taking place, have them do the report and submit the report. If you do business days, that gives me until the following Tuesday, which is more than enough time.
I would be super careful, doing that, because you have to word it exactly right, because I think confusion can come up whether if you're just extending if it ends on a weekend day to the next business day, or if you're only counting.
That's why I wanted to say
Business days.
with you, so maybe you should help write that stip. It was an agent that had been doing it for 20 or 30 years, who's
Yeah.
done this a lot, who did that stip, so I don't know exactly how you should, write it in the
Yeah.
contract, but that'd be something that you could probably help with.
Yeah, happy to, just that one I would pay particular attention to, if you're gonna write something like that, and not just like count out the days and know when it'll fall, because you don't always know, right? Like, if you think you hope you go binding today, but it could be tomorrow, it might shift onto a day you don't want it to, so, just be very specific and careful with that wording, if you're gonna do that.
Yep, and then my last topic that I wanted to go over is just appraisals in general, so, a lot of people are, if they're buying a home right now and they're okay with the interest rates and they're okay with a little bit of a higher monthly payment until they refinance. But their biggest thing is they want their cash to close to be as low as possible. Hey, I don't want to pay any points for the interest rate. I want to pay as low fees as possible. My goal is to get into the home, come into the closing table with as little as I can. Well, another thing, and we've talked about this before, but I think this is very big right now, just because we're seeing some appraisals that, had someone put in an offer 25,000 above asking, appraisal came in at value, we had some people go in at asking price. Appraisal came in $13,000 over value, so appraisals are still getting there with the demand, because it's economics, like the supply is not there, the demand is there. These home prices are gonna continue to go up, so if we get appraisals that come in at, or above value, obviously at value is great, above value is even better. What we've been doing is letting the clients choose what they want to do, and I can send them a loan comparison of the difference. So my example for this one is the loan I had closed last week. They ended up getting 9,000 in seller concessions off of the inspection, so not a big deal on this one. But if they didn't per se, the appraisal came in $13,000 over, so 450 purchase price, 468 appraisal. So if they wanted to, the client could renegotiate the sales price to 468. As the agent, you guys would write a stip in the contract saying the seller's commissions is still based on the agreed upon purchase price of 450. So it's no loss to the seller, but they renegotiate the sales price of 468 and then give 13,000 in seller concessions. So where the cash to close is basically just the down payment at that point. So, just another thought for you guys, if you guys think you found a house that's, maybe underpriced and you're under contract there, I wouldn't necessarily put it out there that, hey, this is what we're going to do, but maybe, hey, this is a possibility if this happens. Just to keep in mind, because whenever the appraisal comes in over value, I always give that opportunity to my clients. But again, if they up the purchase price from 450 to 455, from 455 to 468, that's going to change their monthly payment $20 to $30. So if they're comfortable with that and then receiving 13,000 in seller concessions, they can either use that to buy the rate down to give them no difference in their monthly payment, just get seller concessions at closing, or they can just say, hey, we'll close on the house. We just know we already have $13,000 of equity. So if we turn around and sell the house tomorrow, and we're really probably going to be breaking even at that point, So maybe they'll lose a little bit of money, but you know what I'm saying. So just another thought for your clients that cash to close is their issue. Hey, this is what we can do. Maybe if you get inside of due diligence and have the ability to say, hey, what do you want to do here? But that's just another thing I wanted you guys to think about with the market that we have going on and some of people's units that I've seen.
But that's something you guys have to allow as a lender, right? Like, isn't there like a cap? What do you allow as an allow?
Yes,
You know
so-
what I'm talking about?
Yeah, the amount of seller concessions.
Yes.
Yeah, so if you're putting less than 5% down, or if you're putting less than, it's 9.99, so less than 10% down, your max seller concession is 3%. If they're
Okay.
putting 10 to 25% down, it's 6. 25 or more is 9. Investment properties are just 2%, and that's just flat no matter what they're putting down. And then FHA, you get up to 6% regardless
Of the
what down
purchase
payment
price.
is. Yes, all based on purchase price. And then VA, I believe is 4%. I think it's good what the number is. So with all that being said, that's just another way to lower the cash to close. If the people, maybe they're strapped for cash or they want to save some money to invest elsewhere after closing, these are all things we can negotiate after the fact. And then, you can always just tell the seller, hey, we'll agree to pay seller, the seller will agree to pay commissions based on the original purchase price, but it's still the same net to them.
But don't put that in your contract. I always say, don't put anything with your commission in the contract, because that gives the impression to the buyer and seller that they can negotiate your money, which is not what you want to do. So where that goes is in the instruction, the closing attorney, so your commission agreement, rather than putting 3% of the sales price, just put with that total dollar value. So like I guess really 6%, because each agent gets 3. $300,000 is what, 18,000, each agent gets 9. So instead of writing 3%, write 18,000 and then write 9,000. And that shows, that's what the commission is. It doesn't matter what the sales price is, because you're basing it off of that. And if you have a seller who really wants to see it in writing, like an agreement that they sign, I think you can do a very specific amendment to your brokerage agreement. So that's between you and your seller. And I would say, for the contract between this person and this person on this property, total commission owed to me from seller is 18,000. Or is a percentage of this sales price. And I would very specifically name the property. That way, if it terminates, your full 6% is still gonna be relevant for the next transaction. But I would put it there so that they don't come back and later think they can adjust it. Because we've seen problems with commission where the buyer and the seller then add another stipulation. They both sign off on it. And since you introduce commission into the contract, they think that they can change what your money is. So I would never put it in there just for that reason. Protect yourself.
Perfect. Well, anybody got any questions?
Yeah, one small question. If you have say a due diligence of 5 days and an appraisal extension or contingency of 7 days, if the appraisal comes back and you cannot negotiate, do you still use a unilateral agreement to terminate, or do you use something else?
So what kind of loan? Conventional?
Yeah, conventional loan, let's say in the appraisal, you couldn't negotiate it, so your buyer wants to back out. How do you terminate? What's the proper form to terminate the agreement?
So as long as your buyer has sent the amendment to change sales price to seller, and either the number of days have gone by or the seller has actively said, I do not agree, then your buyer can do the unilateral termination. But you
So-
have to have given the seller the opportunity to change the sales price, and they have to have actively said, no, we're not going to, or the number of days pass.
All right, so you still use unilateral to make that,
Yeah, you can use the unilateral as long as you follow the guidelines in that appraisal contingency, then yes, you can do unilateral. You can
Alright.
always do a mutual termination for any reason whatsoever. It doesn't mean anything until the other side has also signed. So if both sides have agreed to terminate, and on that document it says what's happening with the earnest money, then we don't look back to see, who had a right to terminate or not. It's mutual, and y'all have agreed on what to do with the earnest money, and you move on. But with
Right.
the unilateral, even if the buyer has the right to terminate, the seller still has to sign the earnest money section. If they don't, then the holder has to go through the 10-day letter process, no matter how clear and obvious it is.
what's the 10-day thing again? Remind me.
10-day letter, so what the holder of the earnest money is required to do is we can only send the earnest money out or release the earnest money if certain things occur. So if it closes, we can certainly credit it back to the buyer. We can send it to the buyer or seller upon written agreement from buyer and seller. But if we don't have either one of those things occurring and we're having to decide who gets the earnest money, meaning the buyer and the seller have not come to an agreement, then we have to write what's called a 10-day letter. And what that is saying, hey, as the holder, I've reviewed the contract and this is the party I think should get the earnest money and this is why. But we have to send it to both sides, then both sides have 10 days to respond to that letter. If nobody responds, then we say, we're releasing the earnest money, we send it on to the party we were originally gonna release it to. If someone does send an argument back, saying, no, I think you got it wrong, here's where I think it should go, then we review that. If we agree with them, meaning we've changed our mind, we send out a new 10-day letter saying, hey, we got additional evidence, we've now changed our mind, we're gonna give it to the other party, and then there's 10 days to receive an argument. If we don't receive an argument back, we issue it per the letter. If we do, then, the same process. We review that information, we either change our mind or we say, no, we're gonna do what we said in our last letter and go ahead and issue the earnest money. But it's called a 10-day letter because parties have 10 days to respond to the holder's statement on what they're gonna do with the earnest money.
All right, thank you.
You're welcome. Y'all have any other questions? About anything we talked about writing offers? Yeah.
Well, I guess kind of piggybacking off of that, you know, things a little bit off from this, but as far as when you give them the option to reduce the price on it, should that be through email or should it be through a document that you're sending to like an amendment to reduce the price? Like, which,
There's an amendment to change sales price. You definitely want to do an amendment.
so no email, just.
No email, yeah. So go ahead and put the amendment together, send it over, because you want the seller to be able to sign it and send it back. So definitely do the amendment for it. Now, if the seller is not gonna agree to it, then they can email back saying, we are not gonna agree to that sales price. And that's fine, because you don't want them to sign the amendment if they're not agreeing to it.
Right.
But initially sending it over, definitely the amendment. Any other questions?
There is amendment to this, amendment to agreement, amendment to this, amendment, I know it's a lot, the last one I had to write 5 of them and put them all. It was-
But there's a lot, there is a general flat amendment that you can use for anything.
Yeah,
But the amendments that have specific names, I would use those if they're applicable, because they have other things that are gonna be relevant. Like the amendment to address concerns, it's gonna have the box whether or not due diligence is gonna continue on or whether by signing this amendment, we terminated due diligence. The amendment to extend closing date, that one I would use that if all you're doing is extending the closing date, because that gives the option on whether or not the unilateral is still out and open for use, right? 'Cause you get to use it one time per transaction. So if you don't want that to exist and you're still agreeing, you just check that box. If you're using the regular amendment, you have to write extra sentences and draw attention to stuff. So there's a list in alphabetical order, so you can see all the specific amendments there are, and if you don't see one that's relevant to you, just use general.
Awesome. Well, thanks for coming. Hopefully you guys got something out of it today.
Thanks for having me.
Well,
Thank you.
Thank you.
Any other questions?
no,
No?
well, I mean, well, yeah, but